There is one last example for Chapter 19 that I want to walk through for you. This has to do with net operating losses. So in a particular year, a corporation has a net loss instead of net income. Clearly, they're not going to have to pay taxes on that loss. The issue is that there's actually a benefit from that loss, but the IRS is not going to pay the corporation their tax benefit. What they do is allow the corporation to carry that loss forward. Now, under the recent tax law, the requirements for that have changed. Previously, what a corporation could do was carry the loss back 2 years. So in other words, if they had income in either of the two previous years, they could actually file an amended tax return and get a refund. This would be particularly useful if they're suffering from cash flow issues. It's immediate cash back. Then they could carry it forward, the net operating loss forward, anything that was left over, for 20 years. Now, under the recent tax law changes, what has happened is the carryback has been eliminated, but the carry forward is unlimited, so there is no maximum number of years. Now, as you can imagine, there are advantages and disadvantages to each. I've already mentioned the advantage to carrying back, and that is that you get the immediate cash. The disadvantage to carrying forward is you may not have income to offset that loss again for many years, depending on what is causing your loss. It may take a few years, if ever, before you're able to generate the income to actually receive the benefit. Again, the loss has no benefit for you unless you have some income to offset it against. It's a savings in future tax payments, not a refund. The advantage to carrying forward is that if tax rates were to increase in future years, you would actually get a greater benefit, because the tax rate that will impact your benefit is the tax rate in place the year that you actually get the tax benefit. So let's take a look at this example I've put together. For this company, we have 5 years, 2017 through 2021. For each year, I've given you the income or the loss. So in 2017, there was income, 18 and 19 loss, and then they went back into an income mode. Then I've given you the tax rates for each year, 25% for 17 and 18, and then the tax rate dropped to 20 for the remaining years. Couple of other pieces of information: taxable income or loss and pre-tax financial income or loss are the same each year. So there are no deferred tax items we're having to deal with. I'm simplifying it so that the only point in this problem is that net operating loss. Then another pertinent piece of information is that the tax rates for all years are already enacted into law. That's a critical piece of information, because if you're putting together deferred tax assets or deferred tax liabilities, you would only take into consideration future tax rate changes if they had been enacted into law. In other words, you're not going to make projections about what the tax rate might be. If the tax rate is not enacted into law, if there's merely discussion about the possibility that it may change, you ignore that. The only rates you can use are what are in law currently. So let me walk through the journal entries we're going to make each year. Again, keeping in mind there are no deferred tax items. 2017 is very simple. We have $80,000 in income, a tax rate of 25%. So we're going to debit income tax expense and credit income tax payable for $80,000 times the 25% tax rate, or $20,000. Nothing out of the ordinary there. Now, 2018, the first year that we're showing a loss, we're going to debit deferred tax asset because this is a future deductible amount effectively that we can benefit assuming that we have income, taxable income in the future. Now, notice the amount that I debited. It's the $160,000 loss, but it's at the 20% tax rate that is anticipated in the future. Again, the reason I can do that is that tax rate has already been enacted into law. If it had not been, that entry would need to have been made at the 25% tax rate. So I debit deferred tax asset for the $32,000 and I credit income tax expense loss carry forward. That will show up in my income tax expense section of my income statement as a tax benefit. So it will effectively reduce my loss of $160,000. 2019, we continue in the loss mode, so the entry is exactly the same. It is the $380,000 loss at the 20% tax rate, which now is enacted into law. 2020, we now are showing income. So I'm going to debit income tax expense for the $120,000 in income times the 20% tax rate. But notice I am not crediting income tax payable. I'm not going to credit income tax payable because we have deferred tax assets that were set up in the previous 2 years, and I'm going to reverse those deferred tax assets against the income tax expense. So I have income tax expense on my income statement, but no liability to the IRS. And then 2021 will be exactly the same entry as 2020 because I have not yet used up the tax benefit from the previous year's loss carry forwards. I'll debit income tax expense for $20,000, which is the $100,000 at 20% income for 2021, and then I will credit deferred tax asset for the same amount. Again, eking away at that deferred tax asset that had been set up in 18 and 19, resulting therefore in expense on the income statement, but no payment to the IRS. Now, one last issue. Remember when we talked about deferred tax assets, we said that deferred tax assets are a little different in that the only way you get the benefit is if you have future taxable income against which to offset them. So, if there is any likelihood that we will not have the necessary income to absorb those loss carry forwards, we're going to have to set up an allowance to adjust the deferred tax asset, just as we did when the deferred tax asset arose from a timing difference. And if you think about it, if a company is undergoing losses such that they have those loss carry forwards, there may be more likelihood that it will be difficult or that there will not be a point at which that will turn around. Now, the fact that the tax law currently allows them to be carried forward indefinitely means that may not happen. But the other consideration is that if a company is undergoing losses, reporting losses for that longer period of time, they may not even be around to benefit them. But that being the case, just to illustrate the entry, let's say that in 2019 we determine it is more likely than not that there will not be income to absorb the loss. Then, in addition to the entry we made to debit deferred tax asset and credit income tax expense, we would debit income tax expense allowance, effectively offsetting that tax benefit, and then credit the allowance to adjust deferred tax asset. Again, keep in mind that is a contra asset account and will be reported on the balance sheet as a reduction to deferred tax asset.